SoFi's Q2 earnings is coming up very shortly in a couple of days on July 31st. And leading up to next week, I wanted to share some predictions and thoughts around what I'm expecting to see from the company. Now, all of these predictions are pieces that I've gathered from just extensively following the company, from fireside chats, from the Q1 earnings call. I went back and I listened again. I looked at their Q1 results and their Q2 guidance, and I think that gives me a pretty good grasp on what we can expect. Okay, so first let's start off with some news this week. By and large, the biggest piece of news this week was that the Fed raised interest rates again, another 25 basis points on Wednesday. The market closed higher on this news, probably on a reassurance that there would be no further rate hikes after this. I personally did not think that this would happen. I mentioned in a previous video that I thought it was unrealistic for them to raise again. And in fact, I was against this move, as all of the data indicates that we were moving in the right direction from all of the key major metrics. And by and large, I feel that the Fed has overplayed their hand. Maybe this hike simply ensures that we won't have further hikes towards the end of the year, but I think it's pretty premature to make that decision right now. In fact, I think many Fed members are no longer projecting a recession coming up, which does inspire confidence in the market. And there's a couple of consequences as it relates to SoFi. First and foremost, I think Robinhood immediately raised their APY on their savings. I think SoFi is going to be raising their APY on their savings over the next coming weeks as a result of these interest rate hikes. I think we can see 4.6% on their savings APY. We've seen this have a pretty strong correlation with the Fed rate. And more importantly, it affects SoFi from a personal loans perspective, as a rising rate environment is more profitable personal loans for SoFi, which I think this quarter will come in at a record. We've also been seeing lending numbers at other commercial banks and other competitor companies come in very strong, as we just had bank earnings last week. And this speaks to the macro strength in that personal loan segment as a whole, which is currently the segment that is by and large carrying SoFi's entire business from a revenue perspective. So I expect personal loans is going to come in very strong. This macro rate hike that we saw this week definitely plays into that. In terms of personal loan originations, in Q1, they almost hit $3 billion in originations, which was up 20% quarter over quarter. If we just extrapolate linearly, I think that this quarter will easily surpass that $3 billion number, maybe coming in at 3.4 billion, 3.5 billion, something like that. SoFi's Q2 guidance was for adjusted net revenue, they projected between 470 and 480 million for Q2, which would represent a 32 to a 35% increase year over year. And for EBITDA, they projected 50 to 60 million in Q2 adjusted EBITDA. Now, I'll go through segment by segment in terms of this earnings. I just talked a little bit about personal loans. Deposits, I think Anthony Noto mentioned in the JPM fireside chat that they're aiming for 2 billion in terms of total deposit growth. Personally, I don't see a huge variance for this. I know that we've talked a little bit about in the past on SoFi Weekly podcasts, myself and Tanner. We've talked about varying from the $2 billion number. Maybe we can see 2.4 billion, 2.5 billion, but I think that that's the high point because SoFi themselves is targeting 2 billion for Q2. And this draws a contrast from Q1 where they came in much higher than this number. I think it was 2.7 billion, if I'm not mistaken. But SoFi by and large has been increasing their deposits, and that's also a consequence of this rate environment as well, right? With a high savings rate, then obviously you're going to be increasing deposits. And moving on to loan sales, I think this was a topic that's been discussed in the past. Lending Club reported earnings yesterday. They showed a drop in non-interest revenue quarter over quarter. Basically, Lending Club sold loans, but they sold them at a lower price. They also highlighted in their earnings yesterday that they were forecasting the marketplace to be weaker in terms of demand for the remainder of the year, which could be said from a macro perspective about SoFi's ability to sell loans. I know Anthony Noto has said in the past that they still want to be holding loans until rates start to fall. So initially, they had been planning to sell loans probably in the first half of 2024, which is, when we could expect that. Also, the fact that the Fed raised rates makes SoFi less likely to sell loans anytime soon. When interest rates rise, the value of the existing loans, which were made at the lower interest rate, decreases, right? This is because there's new loans that are now being issued at higher rates, making the older loans, which are lower rates, less attractive. The same logic works in reverse, which is why SoFi wants to be selling their loans as rates start to drop. Because as rates start to drop, all of a sudden they now hold these loans at a very high interest rate, which is more valuable because we're in lower interest rate environment. So there is this relationship between what the Fed is doing and SoFi's profitability around selling those loans. But one thing that we've been seeing is we've been seeing banks increasing their leverage ratios this week. They're adding more safety net. This was something that initially Tanner brought up in our members only video. This idea that SoFi is going to have to start selling loans sooner rather than later because they're going to be forced to. Now, there's a few reasons why SoFi or any company in SoFi's position might be forced to sell loans. The first is simply liquidity, right? We're in a high rate environment, borrowing costs increase. If SoFi needs the liquidity to fund new loans, due to a high demand for their products, for example, it might be more cost effective to sell their existing loans rather than borrowing money at higher rates. So if they don't have liquidity, then they might sell loans. Number two, of course, is capital requirements. Financial institutions are required to maintain certain capital ratios, and if the Fed keeps raising their rates, that's going to impact the value of SoFi's assets, including their loan book, and thereby its capital ratios. So SoFi might need to sell in order to meet regulatory requirements. Now, that's just the second example. The third example is loan demand, right? So if interest rates are rising, demand for loans might decrease as they become more expensive for borrowers. Basically to say that, SoFi can adjust their loan portfolio in response to decreasing demand, which is really what Lending Club was signaling to the end of the year. They were saying that, hey, the environment is going to be brutal for 2023. Lending Club is selling their loans. They're just making less money on them, making lower revenue. So loan demand is something that's affecting Lending Club, and it could be something that could be affecting SoFi as well. So that's number three. Number four is simply risk management. By selling the loans, SoFi can manage and diversify risk in a volatile high rate environment. So they can basically spread the risk of default or late payments. But we've not really been seeing default or late payments for SoFi. Yes, the number has been going up, but it's completely negligible and definitely within their ratios that they're targeting. So I don't think it's going to be risk management. Honestly, I don't really think it's going to be loan demand. And the reason why is because SoFi has these very valuable loans because of their high FICO scores that they're targeting. These are very, wealthy individuals who pay off their loans on time, who have a low default rate, so on and so forth. There's always going to be demand for those high quality borrowers. So really, it's going to be a liquidity or a capital requirements perspective. And I think that this is a real concern with regards to SoFi's ability to sell loans, but I personally don't think that they've already started selling loans in Q2. I don't think that we're going to see any loan sales in Q2. Personally, I've been wrong before and about many things, but I do think that SoFi has more runway to go, at least for another couple of quarters before they start offloading loans. So it might not be the first half of 2024 that we see it happening. It might be, the back half of 2023, maybe Q3, maybe Q4. But I think that management is going to continue on their path for as long as they can comfortably hold those loans on their balance sheet to grow their tangible book value. However, the outstanding question, the $1 million question in the room is whether SoFi is going to be forced to trim or to sell their loans as a result. This is likely going to be a Q3 question mark rather than a Q2 question mark, in my opinion. Moving on, members, I think 450 to 490 is really the ballpark that we're looking at. I don't think that there's going to be over 500,000. Last quarter, they added 433,000 new members. Keep in mind that SoFi, in this macro environment, they're just targeting 400,000 members per quarter. They've done that for several quarters, and after it hits 400,000, they just cut all their sales and marketing spend. In fact, in Q1, they even mentioned on the earnings call that they lowered their sales and marketing spend while achieving the 433,000 new members. Savings APY is high, 4.4%. We might get another increase. That might affect the member count somewhat. But again, I think it's a pretty direct correlation between the sales and marketing spend and how many members they get. And SoFi is sort of manually controlling this lever to say, okay, we got 400,000, let's crank down the spend, let's sit there. But conversely, as the market turns around, they can crank up the spend and they can get 500, 6,000, so on and so forth. I think Anthony Noto said they can get 800,000 members pretty easily by next year. Now, moving on to financial services, this is the most explosive growth of all of their segments. All financial services products were up double digits last quarter. Options trading improvements are going into full effect. The SoFi Invest app got a full reskin. I think the contribution loss for the segment for Q1 was negative $24 million, which has been quickly improving because last year's contribution loss was around negative $50 million. So it was cut in half year over year. And remember, financial services is the company's only unprofitable segment, and that contribution loss is quickly moving towards break even. That's going to be a key number to watch out for SoFi's overall profitability. And so from 24.3 million, I think that we can expect something comparable to that range hopefully inching up towards that profitability, as that is the segment that management has highlighted they expect to be profitable by the end of the year. Moving on to student loans, refinancing surge is huge here. We saw a big uptick twice before, I believe at the end of 2020 and also in 2022, both instances where Biden suggested that the moratorium was ending, people rushed to refinance their loans. And now that student loans are definitively back and the moratorium actually has an end date, it's a hard date, the refinancing surge that we're going to see is huge. Because in the previous two instances, when Biden even suggested that it was ending and definitively just tweeted out that it was ending, SoFi saw as much as a 40% increase in originations and refinancing in both instances. So I predict that now that it's finalized, people are rushing to refinance. And this is something that, we can see a huge spike in originations for student loans as a result of this. Wrapping up the lending segment with home loans. Remember, SoFi purchased Wyndham Capital. This was an acquisition that we saw in Q1. However, the company didn't disclose how much they paid for Wyndham Capital because it actually closed on the first day of Q2, which means that on July 31st, we will actually learn how much SoFi paid for Wyndham Capital. And in addition to that, their plan on integrating Wyndham and maybe an update of how far along they've gotten so far. Because this plan is really going to give us insight on how much of an uptick we can expect from the home loan segment towards the back half of the year, and whether SoFi will be actively promoting their home loan segment. In other words, putting sales and marketing spend in their home loans. I don't think that they're going to do that because demand is going to be low in a super high rate environment. It's not really conducive to people wanting to buy homes when interest rates are at 5.5% on the Fed rate. I think that SoFi is going to wait until market conditions change. In other words, until the rates start to fall again before pumping more sales and marketing spend. And they're also going to have to wait until they integrate with Wyndham. However, I went back to the Q1 earnings call. Anthony Noto mentioned that the integration with Wyndham would not be a huge undertaking and would be accretive by the end of year 2023, meaning that we can expect an uptick from home loans in the second half of this year, which is good because the full year guidance that they gave at the beginning of the year in January does not account for home loans much at all. So that's going to be net positive on the home loan segment as a result of the Wyndham acquisition. Moving on to the tech platform, I think we'll be seeing whether margins and the growth rates are going to be recovering from the Q1 numbers where we saw weakness. Management assured us that towards the end of the year, we would see margins and growth rates comparable to end of 2022 rather than Q1 of 2023, which is much poorer because SoFi lost their second biggest client, Current. And another piece that they mentioned on the Q1 earnings call and also in subsequent fireside chats, they mentioned that they are making a pivot in their tech platform strategy and Galileo strategy to move away from smaller deals and towards larger, more durable clients. This has a pro and a con. The pro is you have more sustainable revenue and you have bigger ticket items, so more dollar value because these are enterprise clients. The con is that you have a longer approval process, you have more red tape, and you have longer lead times. The time from you initially reaching out to that company and you signing a contract might be 90 days, might be 120 days. Whereas with a smaller client, it might be 30 to 60 days. So that lead time is going to be a factor in terms of how they're measuring their margins with Galileo, but they assured us it's going to be back to normal by the end of the year. And overarchingly, with regards to their EPS, I think that Q2 is going to be the quarter that gives us insight whether SoFi can hit Q3 profitability. Q3 profitability is something that I have been talking about for a year now. I think that they can hit it. The consensus for this quarter is -6 to -7 cents EPS. Earnings whisper is -4 cents EPS. I personally think that we can see -3 cents EPS. I don't know if I'm crazy. I think that we can see it. If we do see it, that puts SoFi in a really healthy spot to be gunning for Q3 break even. Last quarter, analysts were expecting -8 cents, and SoFi beat by a good amount. It came in at -5 cents. I don't think -3 cents for this quarter is a very huge stretch of the imagination. That's going to be interesting. And look, if analysts are expecting -6 and Whisper is -4 and SoFi comes in at -3, people are going to start to put together the dots to say, oh, wait a minute, this company can reach profitability in Q3 instead of Q4. And one other thing that I saw that I wanted to mention is the short interest has been rising on SoFi. As the company has been above $8, short interest on SoFi, which typically throughout this year hovered around 11 to 12%, is now around 15%. 15% short interest on an earnings like the one coming up on July 31st if they hit -3 cents EPS, and if their home loans is coming back, if the refinancing surge is as big as I think it will be, if personal loans comes in at a record, which I think it will, I think we're in for a really good time for SoFi next week. We'll see what happens. Earnings on July 31st. I'll be live streaming the earnings call that morning, and I'll also make a video summarizing my main findings on the report. Right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.